So in this video, I'm going to actually expose some investing mistakes that I made in 2018, and I've learned from these mistakes and I don't plan to make them again in 2019. So I want to share them with you guys so you don't make the same mistakes I did and you can learn from my mistakes and hopefully improve your investment style and investment returns from what you learned in this video. Now, if you appreciate me being transparent here with you guys, drop a huge like. Let's try to get this video to 100 likes. And also don't forget to comment down below, let me know what your biggest mistake of 2018 was, and I can make another video to share that with the community as well so that everyone can learn from each other. But anyways, getting into it, my first mistake I would say in 2018 that I made was that I bought too soon and I didn't leave enough cash, or any cash in some cases, on the sidelines. So throughout the last few years, everyone had the buy the dip mentality, and pretty much what this was anytime a stock declined, say a couple percent, you would go in, you would buy the dip, and the stock would pretty much recover in the next week or two. Now, this is especially true in 2017. If you look at 2017, the stock market just kept going up and up and up, and any declines were pretty much a buy the dip opportunity. Well, I personally got too used to this going into 2018, and I had 100% of my capital deployed in the market in 2017 going into 2018. Then February 2018 hit, and this put everything into perspective for me. If you don't remember, Feb 2018 was when we got the first glimpse of volatility in 2018, where we had a pretty good correction and some of the big name stocks out there, even blue chip stocks, had a pretty good decline there. Now, even though I could have gone out there and bought the dip again, the problem was that every time we had a dip, I would deploy all of my cash. So when we had a significant dip, like in Feb 2018, I did not have enough cash to go in there and actually average down my position significantly. Now, if I did have a strategy in place before 2018 where I actually planned my entry points and averaged into a position over time, I would have been much better off with much lower cost bases on certain stocks in my portfolio. So now what I've learned to do in 2019 is whenever I do see a stock start to decline or have a correction, I don't go in and buy 100% of that position. I buy a little bit of it now, wait a few weeks, see if it declines more, add some more to the stock, maybe wait a couple more months, add some more to the stock, and keep averaging down my position. I find that this strategy works for me personally because I am a long-term investor for most of these stocks, and I find that by doing this, I'm able to get a better cost basis, a much lower cost basis, than if I just go in and just deploy all of my capital on any decline that I see. So the lesson learned here for this first mistake is to average into positions, don't go all in, and have some cash on the sidelines for when you do see significant downturns in the market. Now, my second mistake that I want to talk about is I bought stocks that were outside of my circle of competence. So circle of competence is pretty much stocks or industries or companies that you understand thoroughly. Now, if you buy a stock that's outside of circle of competence, you don't necessarily understand how the business works, how they make money, what affects the company, what affects the stock, what affects the industry. Pretty much everything surrounding that company and pretty much everything inside the company is not really fully understood if it's outside a circle of competence. Now, I personally understand tech stocks very well. I've had a personal interest in tech companies and tech stocks for quite a while. I've always been interested in technology in general, so this has been kind of my circle of competence, if you will. However, in 2018, I did dabble into other stocks which I did not understand and that were outside the circle of competence. Some examples would be Manulife Financial or even Caterpillar. Now, both of these companies are extremely strong companies. One is a finance/insurance related company, one is an industrial company. But the problem is that I did not understand how these companies make their money well enough. I also did not understand what affects these companies, what affects the stock price, what to look for to find good value in these companies. All I saw was that these were good blue chip companies, they were on sale, they had a good dividend, and that's what attracted me to them. So for both of these companies, I did cut my losses, I did sell out of these positions, I don't hold them anymore. And the lesson that I would say I learned from this is to really stick to companies that you understand, because that's how you can actually go in, do your analysis, find if a company is truly undervalued and if you're getting a good value for the stock price right now. If you go and buy companies that you don't really understand or industries you don't really understand, it could kind of be seen as a gamble because you don't really understand what moves this company and its stock price. Okay, getting into my third mistake, which I think is something that's relevant to each and every one of you and is something that I really want to drill down here, is buying based on other people's influence or opinions. Now, even though I tell you guys and remind you guys, especially in the comment section with all the comments that I get, do not buy stocks based on what I say, do your own due diligence. I'm not here to tell you to buy company A or company B. I'm just here to provide facts to you. You can use those facts however you want, and then go do your own due diligence to kind of support those facts if you need to. Well, I was kind of a victim to this as well, and I did buy a company in 2018 based on another financial YouTuber's due diligence. Now, I take full responsibility for this. I should have done much more research into this company before even putting in a penny into this stock, so any losses incurred from this position was completely on me. So the stock in question here is Goldman Sachs, and if you're part of the financial community and you watch most of the financial YouTubers, you know exactly which popular financial YouTuber loves Goldman Sachs and holds Goldman Sachs as well. So after watching the video, looking at their thesis, I did a little bit more research, due diligence as well on my own, and I was like, hey, this looks like a pretty good investment. I don't have any exposure to the financial space. Let's buy some Goldman Sachs stock. Oh, and with them being an investment bank and the increase in volatility in 2018, I figured that this would be a perfect stock to own because they make a lot of money when there's a lot of volatility out there. Well, ever since I bought the stock, it did go up a bit, but then it just took a nosedive and just has been going lower and lower and lower. And I'm sure for anyone that understands financials, like Buffett, for example, this is a golden opportunity to scoop up shares in an extremely strong brand, an extremely strong company. However, my fear with this space, financial stocks, banking stocks in general, is that when we do enter a recession, these stocks get hit very hard. And during the last recession, a lot of these companies got to the brink of bankruptcy, and that's not something that I want to actually dabble in my personal portfolio. And the reason for that is I do not understand this company well enough to figure out if it can withstand another recession, if it won't go bankrupt in another recession. I don't have the knowledge or the circle of competence to really understand these kind of stocks. So because of that, I would not feel confident averaging down on a position like Goldman Sachs. And as a result, I figured that I should cut my losses. I don't understand the business. I should not be investing in this company. And I did close out my position. But now on the flip side, if we did see a company like Apple, for example, drop to $100 per share or even lower than that in the next market crash or recession, you can almost bet that I would be buying very heavy into this stock. And the reason is because I understand Apple's business, I understand how they make money, I understand the brand, I understand the segments behind the business and kind of how it's growing. And I would feel 100% confident putting more money into the stock even if the stock price is going lower. And that is a mentality that I want to keep with each and every position in my portfolio. I want to be 100% confident in my decisions. I want to be able to average down when the stock price goes down and not worry about it going bankrupt. And that's why I will only stick to stocks I understand and do my own due diligence on these stocks, not based on other people's opinions. But anyways, in summary here, the lesson learned from this mistake was that you should not listen to anyone out there. Doesn't matter if it's me, doesn't matter if it's Jeremy from the Financial Education Channel, doesn't matter if it's CNBC, doesn't matter if it's Warren Buffett, doesn't really matter who it is. You should do your own due diligence, you should do your own research before you buy a single share in any company. Okay guys, if you enjoyed this and you like me exposing my mistakes in 2018, let me know down below in the comment section. Drop a huge like on this video as well. Let's try to get 100 likes like I said. And also please comment down below and let me know your biggest mistake from 2018 and how you learned from that and what you'll be changing in 2019. Thank you so much for watching guys. Hope you enjoyed this video. Don't forget to invest positively and I'll see you in the next one. Peace.